Hey friends, welcome back to another episode of the Friday Five. Stopped by my favorite little coffee shop this morning. Let's Go Coffee, little plug for them. Got a latte ready to rock, and if you'll notice, I moved my microphone over so it's not in front of my face at my wife's request because she said it looks stupid when it's blocking my chin. So send me an email back. Let me know what you think, or comment if you're watching this online. Does it look better here or here? Anyway, jumping in, mortgage rates where we always start. Conventional 30-year fixed rates at 6.89%, FHA 30-year fixed 6.25%, and VA 30-year fixed at 6.28%. Again, all of these interest rates are quoted from Mortgage News Daily, national averages. So interesting thing I want to point out, I'm going to pop up a chart here and show you interest rates going back to about mid-January, maybe slightly farther back than that. But as you'll see in this chart, I drew a little trend line, and that trend line is showing kind of a move towards lower rates. So some recent economic data has led to this, both inflation and retail sales reports. And I guess the question is this a sign for lower rates or just another one of those head fakes or those temporary improvements that we've seen over the past couple years? Number two, what is the difference between a soft pull credit report and a hard pull credit report? So over my years in the business, we really haven't used soft pulls at all up till the past maybe year or two. But now the industry seems to be using soft pulls a lot. So why would we use soft pulls? Well, one, they're definitely less expensive. So that's a big thing right now. The cost, it does save some money to the lender to pull a soft pull at first. But the other piece of it is that the soft pull credit reports provides the exact same information that we would see on a hard inquiry credit report. It gives 3 scores for all the bureaus. It shows all of the trade lines on the credit report, shows all of the credit history, it shows address history, shows social security number verification. So it literally looks the exact same. And we can even run the loan through the automated underwriting system in the pre-approval status. So it's really super helpful in having a credit report, pre-approving a client without having that negative ding or hard pull on their credit report, which most say can affect their score by maybe 3 to 5 points. So the advantage of it is clearly the fact that we don't have to pull that hard pull credit report up front for the client. Also a little bit of cost savings to the lender initially. And with the life cycle of most customers and the buying process right now, a lot of times if we did pull a hard inquiry credit report up front, it's only good for 120 days. So it may expire before the client ever gets under contract or identifies the house that they're going to buy. And in that case, we would have to pull an updated hard inquiry again anyway. So that's definitely some of the advantages. Limitations. When we pull the soft pull up front, we do get scores, but there is the possibility that down the road when we have to pull the hard inquiry that the scores could change. So that could be one limitation. Also, you could have a negative or derogatory credit account show up, whether that's a late or a new collection on the subsequent hard inquiry that could impact the loan or the credit scores. But we've always advised our clients, ever since I've been in the business, to make sure while you're shopping for a house, you need to be crystal clean with your payments for any accounts that you have. You cannot have any late during that home buying process because it could significantly impact your rate or your ability to qualify. So I really like the soft pull. It's a good option right now. And I think a good experienced mortgage consultant is going to use it to help their clients without it really posing much risk. Number 3, and this kind of ties into number 2, it's pretty common that a client will come to me. We will do either that soft pull or hard pull credit report up front. I'll tell them their 3 credit scores and what their middle score is, and they will ask, why does that differ from what I see on CreditKarma or on the app that my bank provides to me on my phone, and that gives me a credit score? Why is there a difference? Well, there's kind of 3 reasons why you may see a difference between CreditKarma, and I'll start with that one, and the bank app versus what we pull. First, CreditKarma isn't accurate. We'll start there. The credit scoring models are proprietary to the 3 bureaus, Equifax, TransUnion, and Experian, and CreditKarma is really just trying to mimic their formula, and it's not accurate. We tend to see CreditKarma too maybe like run on the high side, like especially Like it could be anywhere from 10 to 20 points higher. Next, like I said, there's 3 different bureaus. So Credit Karma only gives you 1 score. And even if you go on your bank app, you typically only get 1 score. Whereas we're going to pull a tri-merge credit report that gives us 3 scores, 1 from Experian, 1 from TransUnion, 1 from Equifax. Their models all differ slightly, and they all weight different aspects of your credit history a little bit differently. Lastly, each bureau has different scoring algorithms depending on the type of credit that you're applying for. So today, if you went and you applied for an auto loan, a credit card, and a mortgage, even within the same bureau, you're probably going to get different scores because it weights it a little bit differently depending on the type of credit that you're applying for. So when your lender tells you what your credit score is, which they should through the pre-approval process, understand those scores are accurate and don't argue with them because that's never a fun situation. But hopefully if you don't understand why, well, I guess if you watch this video, you will understand why. Number 4, quick tip of the week. Utilizing biweekly payments to pay off your mortgage faster. So a really great and systematic way to pay your mortgage off more quickly. That doesn't make sense, more quickly. How to just pay it off quicker is through biweekly payments. So here's how it works. Instead of making 12 monthly mortgage payments over the course of a year, you break the payments in half and you make a payment every 2 weeks, which 52 weeks in a year, you end up making 26 half payments. So over the course of a year, you end up making 13 full payments. Well, that extra payment that you make every year goes directly towards principal, and it just helps pay the loan off faster. It certainly depends on your interest rate, but I've seen some calculations where it could cut 6 to 7 years off a 30-year mortgage if you just follow that biweekly pay. And it can be really helpful in budgeting, so you don't have that big chunk come out of your bank account once a month. And it follows a lot of people's pay structure where a lot of companies pay their employees on a biweekly pay schedule, and you can set it up to mimic that. So it's a great option. You have to set it up with your loan servicer, and a lot of times you have to set it up kind of so those first 2 biweekly payments hit before the next payment is due. So you kind of want to do it up front, but it can be a really great thing to set up to help pay off your loan a little faster and do it in a systematic way that maybe you don't really notice that much. Number 5, the quote of the week. This quote comes from Sir John Templeton. The time of maximum pessimism is the best time to buy. So be a contrarian. Find a way to, when everyone else is saying no, that's a good time to say yes. Have a great weekend, friends.